So welcome back again to another YouTube video on the introduction to Forex. This is your best video you could ever watch if you want to start Forex trading. This is an introductory part, and if you are new to this channel and you are new to this video, please, there is a first video that you need to watch, which is a part 1 of this video. So you will do well to go and watch the video. I'm going to be putting the end screen in the screen right now, so you can click on it, then watch it first before coming to watch video, because this is a complete beginners class. So I'm going to be taking this class from complete beginners to advanced class. Okay, so do well to watch the first one, then come back and watch this one also. Then you can proceed in the other series of videos that will be released later on in the course of this series of videos. Okay, so that being said, let us go into today's topic. So today we'll be talking about terminology used in trading. Now when I say terminology used in trading, it has to do with trading generally. Okay, generally. So terminology used in trading. So every field of profession has their own terminologies, like their own jargons, like what they use when they are talking. You know, when you see professional doctors speaking to each other, if you're not a doctor and then you hear them speaking, you'll be like, what are these dudes saying? Because you won't understand what they are saying. Likewise, engineers, every profession has their own terminologies. Okay, so also in trading, if you want to trade and then you want to speak the language of Forex traders, you must understand that there are terminologies that are used in trading, and you yourself, you must get yourself acquainted with these terminologies. It is not necessarily used you use them, but so that when they are using it, or when other traders are talking and then they are using it, so that you can be able to relate and understand what they are saying. Okay, for someone like me, I love to break things down to the barest minimum that even a layman will be able to understand what I'm saying. That's the reason that when you watch some Forex advanced videos, you find it hard to comprehend and understand what those YouTubers or what those Forex coaches and traders are saying in their videos. Why? Because they are actually using terminologies in speaking, rather than breaking them down into your own level of understanding, so that you are not yet grown to their level. So they begin to use a lot of terminologies that you do not understand, and then you will not understand what they are saying. Okay, so but personally, I barely use these terminologies. I barely use them in trading, because even if I use them, I'm still going to break it down for you to understand, for you, so that you can understand, okay, well, this is what I'm saying. So the first one is bulls. Bulls. What do we mean bulls? Anytime you hear a forex trader saying bulls mean buyers. That is, the buyers, those that are buying the market, buyers are called bulls. Okay, so understand that. So then we have bears. Bears are known as sellers. So when you hear them saying sellers, the bears, I'm bullish on this market. That means I want to buy this market. I'm bearish on this market. That means I want to sell this market. Do you understand? So that's the meaning. Bulls means buy, bears means sell. Okay. So now we have bullish market. What does bullish market mean? Bullish market simply means a forex market, if a certain currency pairs or a specific currency pair, that the overall movement of that pair is going up. So when the market is going up, it means that it is bullish. It's just like the word bulls. So when people are buying, take for instance now, when people are buying certain things, let's say you bought an iPhone 20 Pro Max, let's say for example, just an example. Okay, so then when you bought the iPhone 20 Pro Max, then you begin to see that probably you bought it for like $10, and as time goes on, apart from you buying it, we have about hundreds of people that have come to buy that same iPhone at $100. If you are the seller of that iPhone, what will you do? You are going to increase the price of that iPhone 20 Pro Max, because you are seeing that people are coming to buy this iPhone very well. So you know that, okay, there must be something about this iPhone that is making it to move faster, and because you want to make a lot of profit, then you move it from $10 to about, say, $15, $12. Do you get it? So when you see that it is still increasing, people are still coming, are still rushing it. Even at that price, you keep on increasing it. So you would only see a price increment when the certain thing you are selling, there are a lot of buyers who want to buy it to keep on increasing. So when we say a bullish market, it means that there are a lot of buyers that are buying that market, that is making that market to move up. So a bullish market is a market that is trending upward movement, going up, up. Okay. Then we have a bearish market. The same thing, just the same thing. When the market is going down. Like, let me use also the iPhone 20 Pro Max again. If you are selling an iPhone and then you're selling it for $10, do you understand? And you do not see buyers to come and buy it, and you are like, wow. Especially, let's say even iPhone is still better. Especially if you are selling a perishable goods that can get spoiled, and because once it's spoiled, it loses its value. Do you understand? So you wouldn't want it to get spoiled, and then what will you do at that point when people are not coming to price or even buy it? You begin to reduce the price, and as a result of you reducing the price, and people are not serious buying it when you reduce the price, so it keeps on going. You keep on reducing the price, it keeps on going down. So so that's an example of a bearish market, when the market keeps moving down. Don't worry, after this video I'm going to be making another video that I'll be making a practical class to all these terminologies, so that you can see it yourself on this chart. Okay, I'm going to be making a practical class to it, so you don't have to try yourself. So we have a trending market. So what is trending? When you are saying that this market is trending, when I tell you this market is trending, it means that it is moving. Is that it's moving up or moving down? So if it's trending aggressively, it's moving up very, very aggressively. This market is trending. The bulls is a bullish trend. If you say this market is a bullish trend, it means that what? It is moving up aggressively. This market is a bearish trend. It is moving down aggressively. Do you understand? Then we have the ranging market. This ranging market has to do with market moving sideways. The market is not going up, it's not going down, it's just moving in a sideways formation. Just moving up and down, up and down, up and down. There's no direction, just moving up. If you go up, it will come down, up, come down, up, come down. So that's a sideways market. Now let's move to stop loss. Now these are the real deal now. So what is stop loss? So in trading, you know, like I told you earlier, that in trading, what you are doing in trading basically is that you are predicting the market. You are predicting that, okay, this market is going to go up or it's going to go down. You understand? So now, and then you are putting money into it, and because you are putting money into it, then it will be bad that for you to put, let's say you put like $100 into it, and then you say, okay, you want to buy, say, Euro USD, and then you now say, okay, from our last class, you should know that when we say you want to buy Euro USD, it means that you are predicting that euro is going to increase in price more than the US dollar. So that means US dollar is going to fall down while euro is going to go up. That's what you are predicting on. So in such a case, so if normally as you put your $100, what happens is that once you predict that, okay, euro will go up while USD will come down. So what you are saying is, so what you have to do is that you have to lose the whole $100 if euro did not go up. That is, if the opposite happens, probably you say, okay, this thing is going to go up, and it did not go up, then that will now come down. So normally you have to lose your whole money, all of the $100 you put in. But what is going to prevent you from losing all your money is the stop loss. This stop loss. There's a place for stop loss before you enter any trade. There's always you see that place for stop loss. Don't worry. There's a practical video I will be showing you where those places are, where you can input those stop loss. Do you understand? So let's say you now wanted to buy, okay, so you deposited $100, then you now analyze the charts, then you now say, okay, based on my analysis of this USD JPY, USD will be stronger than JPY, so USD is going to buy. So you now want to buy it. You now say buy. So when you say buy means you are thinking the buy, that it should go up. That bulls means buy, so it means it will go up. Sell means it will come down. Okay. So you now say, okay, buy. You now click on buy. So, but because you now feel that, okay, that you don't want to lose your whole $100, you can now minimize your loss. That in case if this market did not buy like you predict it, then when I have lose $10 of my money, please take me out of this trade, whether I am online or not online, whether I am on the chart or not on the chart. Take me off this trade. So you will not set that price limit that okay, once it's reached $10, and once my account balance is minus $10, okay, I'm going to please take me out of the trade. So there's a way you set it, which I will show you in a practical video. So once market now, probably you click buy, so the market has started selling. So once your money now reduced to around $10, it's at that price level that your money reduced to $10, so the market will take you out of the trade in loss. So instead of you losing more than $10, you just lose $10, so you'll be left with $90. Do you understand it? So that's what stop loss does for you. Now take profit also. Now this take profit, what take profit does is similar to stop loss, but this time around it stops your profits. Do you understand? Let's say this time around let's say card CHF. Okay, let's say card CHF. You now say okay, you want to sell card CHF. Okay, so when you now analyze the market, then you now started selling. So when you now click on sell, the market favored you and it starts selling immediately. Okay, as the market start to sell, so it start going down. So now your job is to set a price level that you want the market to take you out on. Once this market reach this price level, that once it comes down, once my profits reach this level, just close me out of this trade, whether you are online or not online. Okay, so the market will take you off that trade automatically. So once you now come back, you will meet your money, what you've made, you will meet it in your account balance. As simple as that. So when you are trading, you have to trade with stop loss and take profit at the same time. Okay, you must set your stop loss and take profit. Again, I'll be showing that to you, how to set your stop loss and take profit. So now we move to instant execution. Let's say you analyze the trade. After you analyze your market, and then you say, let's say you analyze, gold. Then when you now analyze gold against USD, then so when you now analyze it and you now saw the market, so you say gold will buy. Okay, so immediately you just click on buy. You will see a place where you click on buy. Everything will be shown in the practical video, which after this video will be uploaded. So you will see the place where you click on buy. Immediately you click on buy, that is instant execution. That is, you are entering the market immediately. That's what instant execution means. You are buying at that same price level. You buy immediately. So why buy limits? Or it does not have to do with buy alone. It can also be sell. Okay, it can also be sell, that you are selling instantly at that price. Maybe the price of gold is around $10. Then you just I want to sell at this $10. That meaning that this market will reduce from $10 to, let's say, $5. So you sell it instantly. So you are selling from the price level of what? Of that place of $10. So why buy limits? What buy limit does is this: you've analyzed the market and then you see that that this market is going to buy, but presently that market is selling. Okay, so you now feel that market is not going to buy at this present price where the market is now. So you now feel market will buy when it gets to this price level. So that is, market thing is still going to come down to a certain price level which you are looking at. That at this point this is where market will. But at that point, when you open your chart, market is still far from getting to that price level, or market has not yet getting to that price level. Let's take, for instance, market is at $2 and you are trading New Zealand CHF. Okay, and you are trading New Zealand CHF, that is New Zealand dollar against Swiss franc, New Zealand CHF, NZD CHF, and then the market is at $2, and then you want to buy, and you feel that this market is going to fall to around $0.1. So instead of you to just say, okay, let me wait till market get to $0.1 before I now buy, you might be busy doing another thing, and then you might have even forgotten, and then by the time you remember, then you now come back to the chart, you might see that market have gotten at around that $0.1, and have moved up and I started buying and I've left you, and probably as the time you open the chart, market was already around $5. Do you know how much you've lost because you did not enter the trade? So to avoid this kind of scenario, so since you anticipate that, okay, at around $0.1, that's where market is going to buy from, then what do? You can then set, there's a place where you set your buy limit. And like, okay, market's at $2 right now, let me set buy limit at $0.1. When market fall down to this $0.1, I'm very sure that at this $0.1, the market will start buying from here. That's all. So then you set it, then you leave the chart, then you start doing other things. So you are not more bothered. So when you now come back, you cannot, what you are coming back to do on the chart is just, okay, you are coming back to check if it has triggered your buy limit or not. That is what buy limit simply means. So the same thing too for sell limit, just the same thing too. But this time around, in a sell scenario, say market is buying, market is moving up, aggressively. Then when you open the chart, you see that the market was at $10, and then you are like, this market will still keep on buying until it gets to like $20. Because if I should buy now, I'm going to be losing a lot of money if I should buy now. So I mean, if I should sell now, market, I'll be losing a lot of money. So let me wait until this market gets to $20. It will still, with what you are seeing, with your analysis, you are seeing that the market will still get to $20 before it starts selling. So you now feel okay. Instead of you moving away from the chart, and then forgetting that, oh, you already said that this thing is going to get to $20 before falling down, you can just go ahead and set the sell limit, and then once market gets there, whether you are online or offline or whatever you are doing, it will trigger that. Once it gets to $20, it will trigger that sell limit, and the trade will start running. Okay, so that is that. All this will be shown to you, how to set the sell limit, how to set the buy limit, how to set everything. It will be shown to you in the practical, and I'll be using a phone because majorly, truth be told, we use phone in entering trade. Phone is your best place. It is easier to enter trade using a phone, while you can also analyze using a phone. I personally, I use both phone and my system to analyze the trade. I use both, but some people prefer to use system, some people prefer to use phone, depending. But me, I'm versatile, I can use both. While some people just prefer just. But majorly, virtually, when you meet, about 90% of traders use phone to enter the trade, while the rest use both phone and system. But so since phone is what is being used in entering the trade, so it's just why that I'm going to be showing you all this example on phone, how to set your buy limit, your sell limit, your instant execution, show you the slot size, place, and everything. Okay, I just said to say this before we move forward. So pips, what is pips? Pips is the movement of markets. I mean, is the movement of price. It is what price is being calculated with. Let me break it down for you. If you as a human being, if you are working, your work is being calculated by what? Your coverage is being calculated by miles or kilometer. Also a vehicle, right? But in the market, if the movement of the market is being calculated in pips, just like the movement of human being or vehicle are being calculated by kilometers and miles, that of the market is being calculated in pips. So if the market should move by 1, so that means instead of you saying that the market has moved by 1 kilometer or 1 miles, you see that market has moved by 1 pips. So that is what pips is, the movement of the market. Okay, it's that simple. Your profit and losses are calculated in pips, but that was before. But now, as you advance, you understand that, okay, that yes, it is still being calculated in pips, but majorly it is best that you calculate your profit and loss based on percentage. Okay, based on percentage. So that is the basics of this thing. I don't want to go into calculation of pips because now you don't need to understand. You don't even need to know how to calculate it now manually, because back then those there were no software or no, like now we have trading view, even MT4, MT5, especially MT5 now, they've upped their game that you don't need to even understand pips before you can set your stop loss and take profit, provided you know the amount you are willing to risk per trade. That is, provided you know the amount you are willing to lose per one trade, and you know the amount you want to win per one trade. Let's say for instance you want to enter GBP USD, then you now say, okay, for this trade I want to lose just $50, and for this $50 I want to make times 3 of this $50, meaning that what we are saying is that I want to lose $50. So you will set a stop loss to the place where you will see where you will lose $50. All this I will show you in the practical. You see the $50 to be shown there. You see the $50. Okay, this is amount I will lose. Then you take profit. You will see where how much you will be losing. I mean, how much you will be making. If it's times 2 of the amount you wish to lose, which should be 150. I mean, which should be 200. And if it's times 3, which is 150, or times 5, which is 250. Okay. So the software has made it easier. Okay, so that's why I'm not going to be going into calculation of pips. So now let's go to lot size. So what does lot size simply mean? Lot size simply is this determines the amount you will win and the amount you will lose. Okay, you must understand that that's lot size for you, and you'll be the one to set your lot size by yourself. Nobody's going to set it for you. You will set lot size by yourself. So the higher the lot size you set, the lower. The higher the lot size, the higher your profit, and the higher your losses. The lower the lot size, the lower your profit, the lower your loss. So it is you that set it by yourself. So if you want to win big, just understand that if you are winning big, if the market should go against you, you will also lose big. You understand that also. So also now we come to leverage. Leverage too helps you in determining your this thing, the money you will be making in forex also. But this time around, the difference is that you are going to set it while registering into your broker. When you choose a brokerage firm that you want to be trading with, so they will ask you the kind of leverage you want to use. So they will give you the option. There are lots of options for this. So you need to choose the leverage you want to use. So leverage is like you borrowing funds. Ordinarily, the amount you deposit in trading is so small that you cannot use that amount to trade. So therefore, what you will do is that once you deposit, let's say you deposit $100, so the broker will then give you some leverage. So you leverage on the money of the brokers. So that leverage that they give you is what you use in amplifying the amount you'll be using in trading. So therefore, if your leverage is so high, just know that you will receive a margin call, or you will receive, your amount will easily reduce if the market should go against you quickly. Understand that? And if your leverage is also so high, you will make more profit than somebody who is using a low leverage. So it's a both lot size and leverage are a double-edged sword. Okay, but you must balance it using risk management, which will be taught in the advanced class as you progress. Okay, so now let's move to margin call. What is margin call? Margin call simply means it's a notification that your brokerage firm is going to give to you when your money that you deposit is almost exhausted. That is, your money is almost going for vanishing. Your account will soon blue. You will soon lose the whole money you deposit. That's what we call margin call. Just like, let's for instance, when you have a phone and then you put your phone, you carry out a phone bill. But in Africa, what we do is that our network providers they are milking us. So you buy a recharge card, you recharge you will buy airtime. So once you recharge airtime, so let's say you buy a $10 worth of airtime, then you call. So once your account balance is going to like maybe probably like going around $3, you start receiving notification from your network provider that you've almost exhausted your call credit. So recharge now. So that's a notification. So it is similar to what we call margin call. You will see it on your chart on your distance. Once you enter your MT4, MT5, you will see it, or whatever platform you are using in trading, maybe cPanel or whatever. You will see it there. You'll be told that you will see that it will on green, red. It will be in red, so you know that your money is almost exhausted. That is, you are almost losing all the money you deposit into that trading firm, into that brokerage firm for trading. So you know what to do. Probably you want to close all the trades, or just leave it for you to blow, and at least that is the worst that can happen. So lastly, equity. So what is equity? Equity is simply the sum total of your account balance, including your trades that are running. Let me explain. So let's say, for instance, you deposit $100. The $100 you deposit, that $100 is your equity. You've not taken any trade. That is still your equity. Okay, that is still your equity. But the moment you enter a trade, and then that trade is going in profit, okay, so your equity will increase. Let's say the trade goes by $10 and you deposit like $100. Your equity will increase, but this equity is not stable. It's not until you close your trade that's when you now have your final equity. That okay, now you've closed this trade. Now either you lose or you're in profit. But your equity is, you are calculating your equity based on your total deposited amount and the running trades that are currently running. That's how you calculate your equity. Start taking. So that's what equity simply is. So I think that's all for this class. So if you enjoyed the video, kindly give me a thumbs up, like the video, share and subscribe, and leave a comments down below. If you have any question, comment below the question that you ask, that you are asking, and that you wish, that you want to get a reply to. I'm going to give you a response to it. Okay, so thank you. Stay tuned, and for the next video, which will be practical. These are all theories that I've taught you so far. So, but I'll be giving you the practical, how to set your leverage, how to set your lot size. This leverage is what you are going to be doing when you consider for your brokerage firm. Okay, so you see it there. So, but the lot size, the sell limit, the buy limit, I will show you your instant execution. All these, I'm going to show you everything, and how to set them, how to set your stop loss, how to set your take profits. All these things I'll be showing them to you in the next video. Okay, so until next time, keep learning and keep researching. I guarantee you, this is one of the best skills you can learn in 2026. Till next time, stay profitable. Bye bye.